the factors behind a blockbuster movie, as you see in the slide, there are a lot of sort of attributes that are put in place for a movie to be successful. And just like this, when it comes to selecting stocks, there are many attributes that go in when you're looking at selecting the right stocks. You look at fundamental factors such as, price to earnings, price to book. You can look at, profitability margins. You can look at return ratios like ROE. So I think there's a lot of metrics that a lot of fund managers use to, really select the right company that goes into investor portfolios. And we believe that, this ability to pick the stocks based on these filters can actually be accessed to a factor fund as well today. Next slide. Next slide, please. Yeah. So essentially, we can use these attributes to gain access to factor funds. The beauty about factor funds today also is that they fall in between active and passive investing, and this is pure passive investing, which is essentially buying the index. We believe that factor investing, is important. That is really gives investors access to portfolios that are have the ability to outperform the benchmarks. So your broad-based benchmarks like Nifty 50 or 500, but also have the ability, have the added advantage of also being low cost. So it sort of falls in between two of these categories, where you're essentially, getting funds that are extremely low expense ratio. So more of your money is invested in the underlying stocks, but you're also getting the opportunity to outperform. What we've seen in India, at least over the last 10 to 15 years, that all the most popular factors, which is momentum, low vol, value, and quality, have actually outperformed the broad-based benchmarks. So I think in India it has been very successful. We didn't have a lot of factor funds that were live, but today I think a lot of AMCs, including ours, have a lot of factor funds that investors can choose from. Next slide. So we talked about what are factors. Next slide. So essentially, factors can also be used for different things. So different factors can be used for different sort of advantages for your portfolio. If investors, so by using a simple cricket analogy, investors can use factors to add like a very attacking mindset into your portfolio by using factor like momentum, which is really helpful, especially in bull market scenarios. The second way it can be used in a portfolio is, next slide, please, is class, which is again, very important. It could be used towards, buying, essentially, sort of recovery sort of a mode where you can buy these portfolios when the economy is recovering through a value factor. And the last is defense. A lot of investors who are looking at, buying defensive options for your portfolio, if you're looking at downside protection, or if you're looking to position your portfolio for a bear market, you can use factors like low volatility or quality, which gives you a lot of downside protection. So it can be used for different ways. We'll also talk about how factors can be used in combination, but these are typically the three ways in which investors can use factors today. Next slide. Next slide. Next slide. So you can go to the next slide. This is yeah. So essentially, every investor who uses a factor in their portfolio, who uses, these sort of metrics, is actually a factor-based investor. And now these are available through very simple funds through the mutual fund industry. Next. We talked about this. Factor investing globally has become, quite large, almost $3.2 trillion, and this is as of 2 years ago. So it's obviously a lot bigger today. So again, a lot of investors are investing to factor funds globally, and we believe that this trend is also coming to India right now. Next slide. So let's talk about each factor. So obviously there are many factors, but the four most important factors are somewhat which are very, very sort of, I would say, popular. The most popular one today is the momentum factor. So momentum essentially, just by the word momentum, is essentially buying stocks that are in momentum. So, you use factors like 6-month and 12-month performance to buy the stocks which have the highest momentum, and that is what you buy in the portfolio. This factor works extremely well in bull markets. It's a factor which has outperformed in a very big way when it comes to comparison to broad-based benchmarks. And we believe that this is one of the most sort of leading factors where there is most demand in India when it comes to factor investing. We've also seen that this factor works across time. across different asset classes, especially equities, and also works across geographies. So momentum factor works in the US, it works in India, it works in different markets. So we believe that it's a very good sort of factor where investors can look at investing. Next slide. So while momentum is extremely popular, globally, the most popular factor tends to be low volatility. So this is essentially a factor that chooses to optimize on your volatility of your portfolio. So essentially, you're buying a basket of stocks that have the least volatility. And the reason why this factor is very important is because it really enables the investor to buy very stable stocks, stocks which have very good balance sheet, very stable companies. They're not cyclical stocks. They tend to do well in both bear as well as bull markets. So essentially, you're looking at buying stocks which are extremely stable and have very low standard deviation. So this is a globally, this is where most of the most popular factor, and we also believe that a lot of investors who are sort of defensive, who want to hold a very sort of low volatile portfolio in their portfolio of stocks, you could use this factor in a very big way. Unlike the US, a low vol factor in India actually is outperformed and done extremely well. So we believe that at least for defensive investors, this is a very good strategy to have a portfolio. Next slide. The third is quality. So, again, this is sort of, very important, but this is also an important factor where essentially, a lot of our investors can choose quality stocks in their portfolio. So the predetermined criteria that, people use are, ROE, debt to earnings, profit margins. So we believe that investors who are looking at buying the index can actually buy a quality version of the index just by buying a quality factor fund. So this is something which is also very popular globally. Essentially, this is also a factor which does extremely well in bear markets. Because in bear markets is where investors tend to stick a little bit more towards quality companies. So again, this is one factor which we're very sort of positive on, especially for investors who are looking at buying quality companies. The last one is value, and this is again, value is something which has been in huge demand, at least in India as well as globally in the last 3 years. I think it is the single factor which has done the most. I think last 1 year performance has been close to 100%. But essentially, you're looking at a factor which does well during economic recoveries. So this is a factor which is also the least, which does really well in spurts. So wherever there is a recovery rally. So we've had last 3 years post-COVID. We had in 2013, again 2009. So those sort of economic recoveries is when this factor does extremely well. Essentially, you're looking at buying the stocks which are the cheapest. So again, the definition of value is subjective, but when it comes to factor funds, they're very objective. You know exactly why that stock is there in your portfolio. In this case, in terms of value, you're essentially buying stocks that have the cheapest in terms of price to book, price to sales, price to earnings. So it's very simple in terms of stock selection. You're essentially buying the cheapest stocks in the market. So this again is a very popular factor today. Value stocks have done extremely well in India over the last 3 years, and you can obviously go there and buy a value fund. Next slide. This is the historical performance of factors. Again, this is the benchmark performance. So this is just for a summary for most investors. What we've seen in India and also globally is, and if you look at the US over the last, say, 30, 40, 50 years, so factors have had a much larger legacy there because it's been around since I would say, 1970s or 1980s. And if you look at the past performance, it has done slightly better than the index. In India, we've seen that factors have also done extremely well. So as I said, factors have the ability to outperform, but also the ability to have very low costs. So it's a very good combination in your portfolio. So if you look at returns also, obviously, these are point-to-point returns, but even then, I think you're looking at close to 3 to 5% outperformance over broad-based benchmarks like Nifty 50. So again, it has shown that it has the ability to do extremely well over long time periods as well. Next slide. So we talked about what factors are and how they are these funds that are governed by certain rules. And we talked about the single factors, which is momentum, value, quality, low vol. You also have funds that are combination of these factors. So there are a lot of funds in the market where you can buy a combination of So they're called multi-factor models, where you can buy a portfolio which has a combination of, say, a value of momentum or a low vol momentum. So that's also something which a lot of investors tend to invest in. But for simplicity, I think we'll stick to the single factor models because they tend to be the most popular in terms of investing. But there are 7 reasons to why we think factor investing should be adopted. First one is factor investing is not ambiguous. What that means is that the rules that govern your portfolio are very, very transparent. So a lot of people feel that factor investing is active investing, or the fund manager is taking a call about what stock to buy, what stock to sell. This is a purely rules-based strategy, and the rules that are in the strategy are completely open, and everyone has access to them. So it's very transparent. So suppose a stock comes into your momentum portfolio, there is, exactly why it's come into your momentum portfolio. So I think it's very transparent, and that's one of the reasons to why it's so popular, is because the rules are just very transparent. Next. The second reason, and this we talked about earlier, is factor investing has also outperformed the index. So the chart shows that all the 4 most popular factors have all outperformed the index over long periods of times. So very important. Not only is it very transparent, but it's also managed to outperform your broad benchmarks. So that's a added value addition, and that's one of the main reasons to why factor funds are very popular. Next. Factor exhibit very less correlation in markets. What does that mean? That means that factor funds are very different from say a Nifty 50 or a Nifty 500. Essentially, when you're looking at adding building a portfolio, and suppose you have an equity portfolio where you want to invest, say, to 4 or 5 different equity funds. It's very important that you're selecting funds that are very different from each other, because if you're buying funds that are very similar, then you're essentially buying the same thing times two. So so it's very important that when you're building out a portfolio, you're essentially building out a portfolio where the funds are uncorrelated or very not similar from each other. And the beauty about factor funds is that they're very less correlated with the broad-based market funds. So this chart shows that the sort of excess returns is what, and also is very different from. So essentially, you're adding a layer of non-correlated exposure in your portfolio, which I think is so you're literally adding value by adding a fund which is outperforming, but also acting differently across market conditions, which I think is a huge value add for most investors who are looking at adding one in your portfolio. Next slide. They also have low correlation with each other. So they obviously have low correlation with the market, which is what you end up happening. But also, if you have multiple factors in your portfolio, they are also they also work in different markets. So essentially, you're buying an asset class that they're buying a strategy which is different from the market or from your usual equity fund, but is also different from each other. A value portfolio will be very different from a momentum portfolio, be very different from a low vol portfolio. So I think essentially all these factors are really different from each other, and that's one of the reasons to why we like them so much. Next. They also have a high active share. So this again is very similar to the second point that talked about low correlation. Essentially, you as a equity investor, when you're looking at buying a fund which is not the index, you essentially want to buy a fund which has a very high active share. Because if you are buying a fund which has a very low active share, that means the fund is very close to the index. And what that means is that the fund may not do well over the long term because it's very close to the index. So post fees, you won't really have that outperformance. But if investors want an outperformance in their portfolio, which they should have, they should essentially look at buying a mutual fund at a very high active share, which is very different from the index. And that's what factor funds do. If you look at the active funds, active share of stocks, as well as sectors, factor funds tend to do extremely well. Next. Factors also very importantly, we talked about performance, and obviously people do look at performance in a very strong light. But it's also important to understand that factors, just like most other actively managed funds, do not outperform every single year. This is a very important aspect. Different factors work in different times. So this chart is an excellent chart that talks about how momentum does well in a bull market, low vol and quality does well in the bear market, and value does well in a recovery market, which is in between a bear and a bull market. Next, there's a nice chart also that talks about the returns of factors in different market conditions. So as I said, factors are funds that have the potential to outperform, but they don't outperform across every market cycle, across every year. So if you're buying a factor fund, don't expect to outperform or do better than the index across all times. It does well in certain times, it does not do well in certain times. But the good thing is that you know exactly why it does badly. So suppose you're buying a momentum fund and it does badly in a bear market. It's much easier to hold on to a factor fund because you have a very good reason to why it sort of did badly or did underperform. And what we've seen is that over the long term, if you're holding these factor funds, it obviously does extremely well. But we do believe that because you have a very good reason to underperformance, then that makes it easier for you to hold on to factor funds for a very long time. So as I said, very important, factor funds do deliver outperformance, but they obviously take a while to deliver that. And you have to either be a long-term investor, for you to really make the most of factor investing. Next. Again, it works everywhere. Works across markets, asset classes, geographies, time periods. So again, it's something. There's been a lot of academic research around factors, and this is something which people have seen time and again across different asset classes. So it's something which is really prevalent across different asset classes. Next. We talked about this, factors, winners keep changing. So, I think, we talked about the fact that different factors work in different times. So very important to sort of keep that in mind when you're looking at factor funds. This chart is, I mean, we'll share the presentation by the end of the show, but it really shows that one color is a different. So this chart shows the highest performing factor, which is on top, and the lowest performing factor on the bottom. And by the color coordination, you can make out that different factors work in different times. So this is something which investors should be aware of when they're looking at investing in factor funds. Next. So using factors in your portfolio, I think we'll sort of maybe quickly go through some of these slides because we'll also talk about this in some of our panel discussions. But essentially, just to I think say factors can be used in different ways. One is obviously, as I said, you could combine factors to create a portfolio. You can add a factor to position a portfolio in a certain sort of market condition. So suppose you want to add a defensiveness to your portfolio, you can add a low volatility or a quality. If you're looking to add an element of aggressiveness to your portfolio, then you can look at adding momentum in your portfolio. So I think there's different ways of using factors. We'll obviously be talking about the ways in which you can use factors in our panel discussions. But again, these can be used as a standalone, or you can use a multi-factor model, or this can be used for market timing also as well. So I think there are very many ways of using factors in your portfolio today. Next. 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 So this is again, we believe at Motilal Oswal that multi-factor approach makes a lot of sense. We feel that combining different factors is something which a lot of investors should make, and just by a simple portfolio of 25% in each factor can actually do very well in terms of your long-term performance. So next. So this is just a very good chart that talks about performance of factors. If you just do a equal weight factor, which is basically putting equal amounts in each factor, it has an excellent long-term sort of return mindset. So I think you're looking at 5 to 6% returns is what he's done over the last 10-15 years time. So overall, what we're seeing is that you can use this is one way in which a lot of our investors are using factors in their portfolio. Next. So, that was just a primer on factors. We talked about what are factors, the different types of factors, what are the advantages of adding factors in your portfolio. And we also talked about, how you can use a multi-factor approach when it comes to building portfolio using factor funds. So with that, my presentation is done, and maybe we can have maybe a couple of questions from the audience before we move on to the first panel. Thank you. So, I'll take a couple of questions before we move to our panel. The first question is from Santosh Kumar. It says, is it recommended to invest in a single or a multi-factor? Can we time entry and exit? So it's a very good question. As I said, different factors work in different times. And in India, if you see the last 15 years, a momentum factor does extremely well in a bull market. Bear market is low vol quality, and a recovery market value does very well. To be honest, timing a factor is what a lot of people try to do, but from experience, it's something which is extremely hard to do accurately. We've done countless studies where we talked about how timing is very difficult to do, consistently well. So even if you get the timing right, getting it right repeatedly is extremely tough over a very long time period. So even though, yes, factors could be used to time the markets, we believe that having a multi-factor approach where, you have a combination of factors in a portfolio tends to do a lot better because it tends to be a lot more consistent in terms of return profile. Also, underperformance tends to be a lot lower when you combine factors, as opposed to, trying to time the market. So I think, yes, you could do it, but historically, what we've seen is that consistently getting things right is very difficult, and mistiming a factor could be a lot more painful than just holding on to the factor for a very long time. So obviously, the we wouldn't recommend it, but that is something which you could do. So there's a sec and so the second question is also a very good question. How are quant funds different from factor funds? This is an excellent question. Actually, factor funds are technically quant funds. The only difference between a factor fund and a quant funds is in a factor fund, the rules are completely transparent. So as an investor, you know exactly what the rules are. What is the rule that governs stock selection for a particular factor fund? Whereas in a quant fund, the rules are not really open or the rules are not really disclosed to the public. And this is because that rule is the intellectual property of the fund manager. So actually, they're very similar funds in terms of they're both rules based, but in a factor fund, the rules are transparent, whereas in a quant fund, the rules are not. And that is the main difference between maybe a factor fund and a quant fund. That is a simple definition of how these things are. So I think just one last question, and then we'll open it up. We'll go to the panel. And this is a very good question. The alpha of factor funds reduced. Will the alpha of factor funds reduced as markets become more efficient? Well, the answer is that the answer is uncertain. But yes, from a logical standpoint, yes, that is true. If you look at the US, the outperformance of factor funds have come down over time. And we believe that even in India, that will probably happen over time. But we also feel that in India, still the market is still very inefficient. So, I think unlike the West, where there's a lot more efficiency, there is the capacity to outperform or get outperformance is a lot higher. So yes, it will probably come down over time, but there is still a lot of at least the internal sort of I would say sort of point is that there is still obviously a lot of opportunity for factor funds to do well in India as well. So with that, thank you for the questions. We'll now move on to the panel, and I would like to just quickly introduce Neil Burate, who will be chairing the panel. So Neil, I mean, Neil obviously is a very popular person, but I just wanted to maybe quickly talk about him. And so he's basically I mean, he's a very notable figure in personal finance. He's a senior editor at Mint, and he heads the personal finance team. And his mission is to basically simplify investing for every Indian investor. And I'll be honest, I think if there is, anyone in the country who's done more in personal finance, I would say it's Neil. He's done a fabulous job, and I'm a big fan of him. He'll be moderating two of the panels today, and I look forward to having Neil on this conclave. Neil, over to you. Thank you.
Thanks, Prateek. That's very kind of you. Um, Folks, so we will have two panels, as Prateek mentioned, roughly half an hour each. We'll have a break in between. And at the end of each panel, we will invite your questions and take your questions. So with that, let me introduce the other panelists in the first panel. So Prateek, of course, will be there. Apart from that, Deepak Shenoy is joining us. So Deepak Shenoy, of course, needs no introduction. He is founder and CEO of Capital Mind, runs an extremely successful PMS, and more importantly for this topic, has implemented momentum investment, the momentum factor extremely successfully. So welcome, Deepak. And we also have Benedict Boros, who is Director of Index Investment Strategy at S&P Dow Jones Indices. Welcome, Ben.
Thanks very much. Good to be here. Looking forward to the discussion.
Awesome. So Ben, I'll start with you actually. If you can give us the international perspective on this, some history about how this has evolved, and how big is this globally?
Yeah, so if you think about the evolution of the index business overall, then we can distinguish three key stages in the development of the whole industry. So if we start in the beginning, in the early 70s, there was no index business to speak of. And today, as Pratik already referred to, it's a multi-trillion-dollar industry. And when it started in the early 70s, the first generation of indices were broad market indices, which means that they were indices with, which represented a whole asset class. So, for example, in the US, it was the S&P 500, which classically represented the US equity market, and each region had their own respective benchmark. And that's where really indexing began. And then the second generation of indices began its development a little later, in the 80s. And in the second generation, indices were either extensions of the key benchmark indices down the capitalization range, so mid-cap indices and small-cap indices, or they were subdivisions into various sectors and industries, think financials, information technology, real estate, and so forth. And then all these second generation indices, just like the first generation indices, were all capitalization weighted. So the bigger the company's market cap, the bigger the index weight within the index. And finally, at least for now, we come to the third generation of indices, and these are factor indices, and that's the topic for today's webinar. And what factor indices aim to do is to give investors access to a pattern of return that otherwise investors would need to pay active fees to get. So in that sense, factor indices let you indicize or to deliver in a passive form patterns of returns that in the past you would have had to pay an active manager to get exposure to. And then the final development within factor indices, as again, like Pratik briefly referred to, is multi-factor indices, because the performance of different factors have been cyclical. So low volatility tended to outperform in volatile and falling markets, and growth tends to do well when interest rates are falling, and so forth. Multi-factor indices basically aim to take out the cyclicality of single factor performance, and they were developed as the latest evolution, and that's the cutting edge of passive investing as of today. Right. And if you look at the evolution, again, like the second part of your question is how assets under management evolved. And if you look at it from a global perspective, we saw that passive investing in general and factor investing also gained in popularity, driven by all the factors that, again, Pratik referred to earlier: lower fees and also better performance in many cases, as our range of global SPIVA scorecards document over the past 20 years. And as a result, according to at least Lipper, which is a leading provider of fund flow data globally, passive funds have reached the assets under management of active, looking from a global perspective. So at the end of last year, both passive and active assets under management stand around $15 trillion each. And within the passive universe, about 20% of assets under management are linked to various factor strategies. Now, I think there is an interesting and important question to address here. Again, that I just want to expand upon what Pratik briefly referred to, is that, will the alpha disappear from factor indices, or would passive investing in general make markets less efficient? And that's a question we face a lot, and we discuss with investors a lot when talking to them. And we see two important flaws in the arguments that the rise of passive makes capital markets less efficient. And one of those flaws in this argument is that at least when it comes to capital formation itself, indexing only occurs once companies are already listed in an exchange, which means that the funding for startups still remains with banks who do debt financing for them, and venture capital funds who provide equity. And indexing has an impact on neither of these. But if we just stick to actual listed equities, we also have to make clear or make a distinction between assets under management and the share of trading. And the very important point is that from the perspective of market efficiency, what matters is not passive assets under management, but the share of trading that passive investors do, because new information about securities is disseminated not via just holding them, but via trading them. And by definition, active has a much larger share of trading volumes than passive. And just as a simple illustration, if we assume that passive turnover in a portfolio is, let's say, 10% per year, and active turnover is 50% per year, which I think are assumptions which are fairly realistic, then the passive share of assets under management would need to rise to 83% of the total before the share of active trading volume actually drops below 50%. So I think concerns about the rise of passive are greatly exaggerated in the popular opinion.
Right. Pratik, so if I could go back to first principles, just to understand why factor investing works, because passive investing itself stems from the efficient market hypothesis, which says you can't consistently beat the market, so you just invest in the market and you'll be fine. But now we're saying you can beat the market if you adopt these strategies. So how is not contradictory?
Yeah, no, it's a good question. I think we keep talking about can active funds beat passive funds, but then now we have a conference that talks about how passive funds can beat passive funds. So I think honestly, so if you look at the theory of efficient market hypothesis, it's again, I think there are a lot of pros who agree with it and who disagree with it. I think obviously in a country like India, there is a lot of inefficiency. It's not as efficient as what you would see, say, in the West. So there is obviously a huge market for active stock picking, and there are obviously premiums that factors have. And I mean, if you look at the last 10, 15 years time, you can see that factors have done pretty well. Also, I feel that if you look at the index theory, and if you read reports from Vanguard or some of these AMCs in the US, they talked about the fact that what really one big reason to why, at least in the US, passive funds tend to fare better is because of the cost aspect. If you just adjust for cost, so if you don't adjust for cost, then passive funds will be right in the middle. But then if you adjust for cost, they will be beating most of the actively managed funds. And this is in the US, obviously. So I think factor funds offer that sort of dual advantage of being able to obviously work in certain cycles, and also the advantage of cost. Again, very important to say that for you to have the ability to outperform, you also have to hold on to these funds. So again, it does potentially outperform, but again, very strict market conditions. So that is something that you'll have to keep in mind when it comes to factor investing.
So Deepak, how did you stumble upon momentum? What's the story? What was Eureka moment?
Neil, I've been, I think, a fan of the concept for much longer than I knew it was a concept itself. It started off when I think, very, very long back, read a book by, an interview of Ed Seykota by Jack Schwager, where he talked about, how Ed Seykota would believe in trends and trends, the idea that trends sustain and then trend following itself can beat the market led me eventually to looking at companies that were trading close to all-time highs or at all-time highs. Being one of the first strategies that I built as a concept, saying listen, this can actually work. When everybody else looks at buying stocks at lows, I want to look at buying stocks at highs. Which is what got me excited because when I tested this out, and I at the time was not really concerned about the fundamentals, but more about the price action. Just buying stocks at all-time highs, whenever those all-time highs are. So if I'm in 2004, it's about the all-time high as of 2004, and then holding them for a certain period while with certain rules of exiting when they kind of fell off those or well fell off the highs by a certain percentage, a stop loss, if you may. That was the beginning of the thoughts of momentum. Eventually, it evolved into a more cross-sectional, formal strategy, which kind of meets a lot of the research that has been done in the past, where the research actually talks about how it was in the 90s when, there was a paper by Jagdish and Titman, I think, that just talked about exactly how to design a momentum strategy using 12-month and momentum rate of change over 12 months, ranking all the stocks within them, and then selecting the top ranked stocks. In terms of that, we had to, of course, modify the strategy for India quite substantially. They used a lot of concepts that perhaps don't make a lot of sense in the Indian context, because our market cycles seem to be a lot lesser, influenced a lot more by the futures and options cycle in India, which is a lot more popular than stock market cash cycles. So our cycles are shorter. We can't use 6-month rotational, as the indexes do, unfortunately. So there is better performance to be had, perhaps by modifying these strategies and backtesting them appropriately. And then you discovered eventually that momentum was actually had two advantages. As a factor, it had evidence. So you could go back to evidence-based investing and saying, I could actually prove that I can model how this strategy would have worked had I not been had I had not had any discretion at all. The unfortunate problem with real world investing is that you end up making decisions at the wrong times, saying, Acha, this is HDFC Bank, I don't want to sell it, even though the strategy is telling me to sell it. So these are the discretionary powers that kind of ruin your strategy mix over time. If you don't take those decisions, discretionary decisions, how would your strategy have performed? You can actually marry that with your actual performance, because many times you do take these discretionary decisions, and sometimes it'll turn out that it's a good thing, sometimes it'll turn out it's a bad thing. By and large, we've found that it's not really a good thing. And then, adding layers to this, which make momentum an interesting cycle, because we looked at all the factors, whether it was value, and value is well practiced, right? So it is not like called a factor, but a lot of funds, there are mutual funds that are actually called value funds, though they're active funds. They are discretionary value funds in a way. People look at value, but then we kind of modeled value according to the way they were, imbibed into the literature and the architecture of factor investing itself. We found two problems. First, you can't trust the data, because a lot of the underlying rules of what define what value is, profitability, capital employed, the way something is called as debt versus what is not called as debt, the definitions have changed, unfortunately, over the years. The last 10 years itself, what was not debt 10 years ago, today is called debt. So it's very difficult to have a common definition value strategy that works across the landscape. The second problem, of course, is that the frequency of the availability of the data and the time frames. You have only about 15 years of data in India for the most part, 15 to 18 years. The US is a lot more rich data. So you end up with working with 15 years, which is hardly 2 or 3 cycles. So you don't get really properly long-term tested cycles. Before 15 or 16 years, the data is very suspect, not easily electronically available, and sometimes has discrepancies that are so wide that you can't meaningfully use back tests on them. So despite that, we tested a bunch of these factors and found momentum is the most attractive in terms of if you are willing to live with the volatility, which is higher than perhaps low volatility as a strategy, but much lower than value substantially. If you are willing to build strategies that could take cash positions as well, which is unfortunately not possible in an index approach, you could actually further reduce drawdowns substantially. Then yes, you have a strategy that's quite interesting. So sorry for the longish answer, but it was a discovery path that went from trends to eventually formal momentum.
Understood. So Prateek, one point you made earlier was that you prefer a multi-factor approach rather than a single factor. How do you choose which factor to embrace when you said it's hard to predict these changes? Do you have a model in mind? You did show one diagram where something works in a bull market, another factor works in a bear market, and so on. But how do you identify even those turns in the market?
Yeah. So, essentially, I think, well, the whole idea behind multi-factors is essentially you have a factor that works in different market conditions. So, just a simple equally weighted strategy, which is something that I showed on screen, which is basically 25%, I would say, exposure to all four factors, all four. So if you just put 25% of your money in all the four factors that we have, that has a very sort of much less cyclicality in terms of return profile over buying into a single factor. Essentially, and that's how a lot of investors tend to use factor investing when they get to, basically pick and choose the factors that, they like or what works for them. For example, just a simple, very simple sort of, I think if you look at like an equally weighted strategy across four factors, that has a churn of about less than 5%, about 4% churn. So you never have to ever churn your portfolio, rebalance it because it self rebalances each other. And it also has historically very good sort of rolling returns, point-to-point returns. Again, this is not advice. This is just something that we do internally research, and we've realized that like a combination of maybe two factors. For example, in India, I think the two factors that really make a lot more sense in people's portfolios tend to be momentum and low vol, which is also the two of the most popular factors. But again, having a multi-factor approach is something which adds an element of consistency into your entire return stream, which is what I think which is why at least we at Motilal Oswal have all the building blocks so that you can create your own multi-factor model.
Yeah. Ben, I'm going to sort of preempt one of the audience questions and take it up in the panel discussion, which is there data which shows that factor investing has beaten the S&P 500 over long periods? Is there something you can point people towards, a resource or some data?
Yeah, absolutely. So we have a factor dashboard which displays the S&P 500 based factor indices, and we publish that at the end of every month, or at least or actually to be more accurate, in the first few days of the following months. So the most recent version is for April 2024. And in that report, we have a very detailed set of statistics for our S&P 500 based factor indices going back to 15 years, because that's around the time when the broadest range of our S&P 500 factor indices were developed. Obviously, value and growth were the first ones, which were launched in 1992. 2003 was the launch date of the equal weight index, and and then all the other factor indices were launched a couple of years later. And over the past 15 years, which basically covers all sort of market cycles, including bull market, bear market, COVID pandemic. You can see the performance of various factor indices. So the best performing one over this period was the S&P 500 growth index, which benefited from a low interest rate environment. We talked about the fact previously that various factor indices perform well in various market cycles, and growth is one that benefited from the 10-year plus of ultra low interest rates in the past 15 years. Whereas low volatility, for example, if we just look at the past 15 years, did underperform because it is a factor which overall at least underperformed, which because it was a predominantly bull market. Obviously, it showed its mettle during the COVID downturn and also in 2008. So there were periods when the benchmark fell and the low volatility performed much better. But if we look at the past 15 years, which the factor dashboard refers to, then that was a bull market. So that's available free of charge. Please take a look. Happy to point you to the right resource or the right link, or to the sign up page should you wish to receive it going forward.
Yeah. One interesting point that struck me during Prateek's talk is that a lot of us practice factor investing without actually knowing it, without actually calling it that. And I was just thinking back to the army of Indian retail traders who draw trend lines and try to make profits on F&O. They're actually trying to do momentum, but quite inefficiently, right, Deepak?
To some extent, the formalization of this process. So you look at two kinds of things, right? Where you have a cross-sectional momentum, where you would actually, or cross-sectional strategies, where you rank all stocks independently on one kind of criteria. Now you could do a multi-factor like this, where you could say, I'll give you a value rank, I'll give you a growth rank, I'll give you a quality rank, I'll give every stock a rank on each factor. Combine these ranks and say, well, your combined rank is so much. This becomes an effective multi-factor strategy. Equal weighted would be simple. I think you can say I can give you 50% weight to momentum and so on. Another way is to say I will rank all stocks on momentum. I'll select the top 20. I'll rank the top all stocks on value to select the top 20. This is a sleeving strategy where you have different sleeves and you can independently run those sleeves. So either 80 stocks across 4 different factors, or you would actually combine them in some way, a meaningful way, or maybe a weighted way, and then come to, you'll get different results through an integration approach like this, or through a multi-factor ranked approach, which is the first one that I mentioned. But we found that is more formal definition of how we use a cross-sectional strategy. You'll always have a bunch of stocks that meet these criteria. They're the top of your list. In a typical ranking, in a typical trend following strategy, you draw lines or you say there's an all-time high in a bunch of stocks that you've pre-selected. That's because you can't look beyond those stocks. You look at, so what happens, for instance, if you have 20 stocks in your portfolio and a 21st comes in. Now you don't really have a rule to say, what stock do I remove from my portfolio? Do I just take the weakest? There's a pigs in a trough concept where you say, if a new stock comes in, the way pigs feed themselves in a trough they just sit around it. And then if a new pig comes in, it just pushes its way in and the weakest pig comes out of it, right? So you kind of do that where for stocks, where you say, when a new stock comes in, I'm going to find the weakest of the ones that I have currently, according to perhaps some criteria, and do this. This is a different way to work things. Affords itself, unfortunately, to way too much discretion, because sometimes they say, well, this trend line is not exactly hitting it, and all of those things that come in. But if you were able to build something formal out of it, you could build a quantitative approach to something like this, but it won't be factor. it will be a slightly different concept. And I think we sometimes tend to get confused between trend and momentum. Momentum is a slightly different way to look at things. The formalized version would be to quantify this mechanism into a way you will independently rank stocks. But yes, I think the ideas behind all of this sometimes are behavioral, sometimes are the same things that drive factor investing forward. Value, for instance, has a very interesting. I mean, it's the underdog theory, right? So you pick the stock that has not been liked by the market, but you know can do better. Whereas momentum is the exact opposite. You pick the Virat Kohli, which is in form, and therefore he's going to score the century next time. And you know what? Most of the time it works. That's the approach that you might actually be taking. Both cases, that's the reasons they both succeed, but they may succeed in different times, and you might find that value being the opposite of momentum in some views may actually succeed in the long term as much as momentum strategy does, but just not at the same exact periods of time.
Right. Now, I'm assuming that in some of the factors like momentum, there's a high level of churn, which would lead to transaction costs and tax leakage to the government, uh, which in turn means that probably a mutual fund wrapper is a good way to package it all in. Um, so, Pratik, if you could just talk us through the MF options and also costs. So one of the big advantages of approaching it in a passive manner is you reduce your costs. So how much are the cost differentials?
Yeah, so I think when it comes to churn, factor investing tends to obviously have much higher churn than your broad-based indices because you're looking at, I mean, it also depends on which factor. So a momentum or a value tends to have a lot higher churn than maybe a quality or low vol. But essentially, yes, you are looking at funds that have a lot higher churn overall. So like a mutual fund structure tends to be very efficient when it comes to accessing factor investing because we at Motilal Oswal mutual fund don't incur the same churn costs or we have certain tax advantages in place which make it easier for us to manage factor funds. But essentially, I think yes, you are looking at higher churn strategies, but it's not really extremely high. I think you're looking at about between 100 and maybe 150% churn, sometimes below 100%. So I think it's not crazy churn, but yes, I think because of churn, because you're investing in an index fund or an ETF, factor funds tend to have tracking errors or tracking differences which are slightly higher than what you would expect in, say, a Nifty 500 or a Nifty 50 fund. So that is something investors should just keep in mind when you're looking at factor funds. There will be a slightly higher drag in your returns compared to, say, your simple vanilla broad-based funds. In terms of options, obviously, 5 years ago, we didn't have a lot of options. In fact, maybe very, very few, maybe a couple of options. But today, I think there are a lot of factor funds that are in the industry. You have single factor funds and you have multi-factor funds. Single factor funds are funds which are essentially tracking the single factors like your quality, low vol, momentum, value. So essentially, you are able to buy ETFs as well as index funds across these four strategies. You also have something called alpha strategy, which is similar to your momentum strategy. Whereas you also have a multi-factor approach where a lot of AMCs have funds where you could look at buying a combination of factors and also buying a combination of factors across different market caps. So even though factor investing is popular in the large cap domain, you also have factor funds where you can buy on mid and also small caps also now. So essentially a lot of options. Yes, it's a little bit confusing, but I think investors who are interested should ideally look at this strategy and maybe select one or two stocks that works for them.
We have a rated question here from Madhur, which says, is it better to play it through ETF or MF? You guys have both historically, so which is better in this case?
I can go first. I think both are, honestly, it really depends on preferences. When it comes to ETFs, make sure that you are buying. So what happens in a non-Nifty 50 ETF, or at least in ETFs in India, they tend to be very illiquid. So when you're looking at buying and selling ETFs on the exchange, then make sure that you're buying it close to the INAV. Now you can obviously check INAVs and all the AMC websites. So make sure you are buying it maybe close to the INAV. It'll be impossible for you to buy it at INAV. Sometimes it might be, but make sure you're not paying too much when you're buying and not selling at discount. Obviously, if you want the easier way, then obviously index funds a lot easier where you're getting end of day NAV. But again, the rule is whatever you guys think is convenient. The returns are pretty much going to be very similar. And,
Deepak, you want to add to that?
Yeah, so I think, ETFs, we don't really recognize some of the elements in it sometimes from the outside, but ETFs have a significantly lower cost because they don't pay STT on any of the transactions that the mutual fund has to do in order to rebalance an ETF. That means every 6 months, if momentum index changes, the ETF does not pay that cost. So in India, unfortunately, at this moment, the costs of passive funds are very high, especially in the factor domain. Momentum funds itself, even if you buy it direct as a fund and not as an ETF, the typical momentum, the lowest momentum fund tracking difference, which is the difference between the index and what you're actually getting, is 42 basis points, 0.42%, but most of the others are above 1%. There are some funds which are underperforming the index as an index fund also, but underperforming the index by as much as 2%. Some of this is attributed towards the STT cost, because every time you buy and sell something, there's 0.1% that goes to the government. This STT cost is not there in ETF. So the same mutual fund house that has a momentum fund where the cost is the tracking difference is 1.9% below the index. The same ETF of that same mutual fund company will have a tracking error difference of only -1%. So what is -1.9 for an index fund is -1% for the index ETF, simply because of this difference. But these numbers are very high. I think the maturity in the space will come in as we get more and more volumes. But you have to understand that the difference is that. But where do you pay for the difference? When you enter. So you'll never get NAV, you'll get a little bit more than the NAV. Now, if you pay 5% more than the NAV, this is not going to make up for anything. You have to pay as little as possible, maybe 0.5% more. And the reason for this is you're going to buy once, but hold it for, let's say, 5 years. The idea then is, therefore, this little 0.5% extra that you pay is spread over a 5-year time frame. So it's only 0.1% per year extra. And that 0.1% is made up by the fact that the ETF has much lower tracking differences. But again, two things. If you don't plan to hold for 5 years, and you don't know what an INAV is, you might be better off buying the index fund anyways. Just saying this because INAVs change every 2 minutes. You need to know where to get them. You need to be able to track them from your purchase price, and you need to be in front of the monitor, making sure that because the INAV is changing, your buy prices are changing during that time. And you still may not be efficient because you might have found the worst time in the day to have purchased that ETF. And if that cost differential was your criteria, you might end up feeling really lousy about it after you analyze the end of the day play versus which is what the index fund would have given you versus what the intraday ETF price would have come in. Plus, you get weekends to buy index funds. So you can't do that on an ETF.
So one very defining feature of our market in the past 1 or 2 years has been the mid and small cap rally. Does factor investing extend to all segments of the market? Are there some bits where the liquidity is just too poor to implement this? Both Deepak and Prateek, if you could take this up.
I'll go first.
Yeah, go for it.
I'll start with the problem. There is an alpha index. It's almost impossible to replicate in real life because a lot of these stocks just simply sit in circuits. There are lots of smaller cap stocks that kind of come in here. And India has the concept of circuits for non-F&O stocks where you have 20% circuit one day, then the subsequent day is 10%. So if it's going up like that, your index is assuming you have them, but you can never buy them. You're sitting there saying, oh, I can't participate. Some of these stocks have recently, we have found that they were the top performers in certain indexes, but at some point they were, unfortunately manipulated. So there is that concern that there is a lot of activity that goes on in some of these smaller stocks, which is not the most, best in terms of corporate governance, which therefore leads you to believe, because some of the larger cap based indexes in, especially in factors, tend to select the more, among the top 200, but some of the others go into the top 500, top 700, and so on. There, you might find some of these stocks dominate, and they might be the significant bearers of returns. So your index fund may not actually be able to participate in those stocks at all. We've found this many times. But in general, I would say the liquidity depends on market cycles. Today, what I would call liquid, or 5 years ago, what I would have called liquid would actually be called illiquid today, because market volumes have absolutely exploded today. But we would love to get a stock that trades 20 crores or 40 crores a day in 2019. Today, our limits are like 80 to 100 crores. That's below that, we don't start looking. So things change in the market, and what will be useful in India may not be applicable in the US. What is in fact a large cap in India is sometimes the bottom end of the mid caps in the US. So you can't even apply the same filters when you start looking at different stocks. And your AUM also becomes a determinator. The more money you have, the universe shrinks in terms of liquidity. So it's not just the index, it's also the AUM, it's also the type of market you're playing in, bull versus bear, that changes the game.
Great. Prateek, you want to add to that?
Yeah, I think in terms of, there are, factor funds across large cap, mid caps, and small caps. So I think investors today, have the option of investing in different categories when it comes to factor funds. So I think that is available. And, honestly, talking about liquidity, there is obviously, as Deepak mentioned, an explosion in liquidity, especially in the last 3 years. But also there's also been an increase in market caps also. So I think you have a combination of a lot more trading volume, plus you have companies who are getting a lot bigger. I mentioned this the earlier days, but the average mid cap company in India is quite large, is about over 60,000 crore. Average small cap company is upwards of 25,000 crore. So you're looking at, very sizable companies, and these will only grow over the next, say, 4 to 5 years time. So and also factor funds, or the factor landscape today is not as large. Looking at factor fund, there are tens of thousands of crores in assets. That'll probably happen over the next, say, 3 to 5 years time, when liquidity will get even better. So I think at this point of time, we don't see liquidity as a big concern when it comes to factor funds. As AUM increases, the market will hopefully also increase, and also add a lot more depth. So I think also, as AMCs, you have to look out for these things, and do a very good job of risk management. So I think that is something which most AMCs are aware of, and hopefully, I think we won't see an element where factors will be ahead and the market does not sort of keep up.
So we are out of time. I'll just invite closing thoughts. Ben, if we can start from you.
Yeah, so I think the key takeaway from our session is that factor indices help to tailor portfolios and help to implement tilts towards certain characteristics, be it low volatility or growth, or even like one interesting tilt that we haven't talked about, but it's one of the most popular, is various dividend paying strategies that used to be available only via active management, and they are a transparent and liquid way to basically access parts of the markets, or parts of or sources of returns that have only been available via the active route historically. So I think that's a strategy that's worth studying and digging deeper into. And again, I just want to draw attention to the range of free resources which are available from our website if you want to learn more.
Thanks, Ben. Deepak?
Yeah, quick close. Of course, we've been running Momentum as a PMS, so I won't take too much time in saying this, but we do have a running Momentum portfolio As a PMS, we had a small case as well, but we also have a multi-factor strategy called Resilient that's been running for about 2.5 years. So these things are practically A, possible, and B, I think implementable with discipline now in the markets. We do have a bunch of papers at capitalmind.in that talk about how you should think about momentum. And in fact, the worst time to buy momentum is probably when it's doing too well. And the worst time to, in fact, the worst time to buy anything is when it's doing too well sometimes. But when I say doing too well, I mean like when you have consistent multi-year returns, it almost feels like this is the holy grail. Is usually when you should not invest in something, but that's the antithesis of momentum, right? So when there's too much momentum in momentum is where when you get scared about investing. But I think the idea of any of these strategies is this: don't look at 1 year. At 1 year, a value strategy or most of these strategies outperform only 67% of the time. Momentum does a little bit better, maybe 75-80% of the time. It outperforms. But take a 5-year view. Ignore the intermediate time frames. Take a 5-year rolling view. You'll find that low volatility, profitability, or momentum in general tends to outperform more than 95 to 100% of the time from the broad indexes. So you have to, if you can't take the heat, don't go into the kitchen kind of a thought process. But the idea is you're going to have to face periods of times when you feel this is the worst time to have invested in momentum. I don't want to be invested here. But you have to live through those times to see the good times. So in general, I would say a factor-based approach needs to take what I call your uncle point into the theory, which is that if you invest in some of these strategies and they underperform for a while, there's a point at which you kind of feel you've lost so much money that you want to call your uncle and for help. So you have to understand that all these strategies are uncle points that sometimes can be greater than the market, especially value, which by the way fell some 59% during COVID times. But if you are able to digest the volatility, factor-based investing, and as we found in the PMS with even post-tax, post-transaction costs giving fairly substantial, nearly 2x return compared to the indexes, is actually a rewarding strategy. I've had my money in all of these, and I would say everybody needs to understand before they invest. But if you find the discipline of your own self to be able to think of these as long-term investment strategies and not really something that you pick for 2024 versus 2025, I think these are great options for building wealth for your own retirement, for your own long-term goals. I'll leave it there.
Fantastic. Prateek, so are we at the cusp of a major boom in factor investing? What do you see happening going forward?
I think, yeah. So, honestly, I think I used to, be a wealth manager in my previous, avatar prior to 2018. And, I had about 600 clients, all 25 plus million in assets, so all ultra HNIs. And I saw that almost all of them had a factor fund in their portfolio. And also, I don't know, it's even though it's not a very sort of popular term in terms of people, a lot of people don't talk about it publicly. I think if you look at the actual amount of money invested globally and also in investor portfolios, tends to be very high. And I think also historically what we've seen is that there are trends that emerge in the West and they come to the East. I think investing also, we've seen a lot of trends that have emerged in the US and other developed markets that have come in. And I think factor investing is one such trend which has grown. And I think there are a lot of investors globally who have benefited from factor investing. And I feel like that will probably happen in India over the next 5 years' time. So yes, I think we do think that this could be a big space. And obviously, just as passive investing was in 2019, lack of awareness was the main reason to why there was not much participation. I think with factor investing is the same thing. There's not a lot of awareness. And I think as and when we evolve, there will be a lot more awareness, and hopefully we'll be able to do a lot of education in terms of factor investing, and we'll see that trend normalize in India as well. So that's the last thought.
Superb. Thank you everyone for joining in. As Prateek said, 2019, nobody was thinking of passive. That's when they launched the Nifty 500, the small cap. The rest of it is history, the small cap rally that followed. Another prescient moment was probably the Nasdaq ETF launch in 2011. So I'll bookmark this moment, and hopefully we can circle back to it after a couple of years. Thank you, everyone. We'll take a short break now before the second panel. Uh, we're back. So today, in the second panel, we'll talk about some of the more practical aspects of factor investing. So let me quickly introduce the panelists. So we have Harsh Ruta. So Harsh is the founder of Fee Only Investment Advisors. He's a well-known personal finance expert with the fortnightly column Truth Be Told in Business Standard, and is also the author of The Complete Home Loan Guide, Where to Go Home to Ask What to Do. Thank you, Harsh, for joining us today. We also have Vaibhav Porwal. So Vaibhav is the co-founder of Deserve, a wealth management startup run by a team of investment experts who held senior positions at companies like IFL Wealth, Anand Rathi Wealth Management, and Kotak Wealth Management. The team had prior experience of managing over 50,000 crores before launching the firm in 2021. Thanks for joining us today, Vaibhav.
Thanks, Neil. Thanks for having me.
And we also have Sankar Narayan. So Sankar heads the quant strategies for Magma Ventures, where he's responsible for the quantitative trading vertical focused on cash futures and options markets. He has over 10 years of experience in research, design, and management of quantitative investment strategies. Thanks for joining us today, Shankar.
Thanks for having me.
So Harsh, if I could start with you, when you talk to clients about this is a very complex topic, a complex area, do they understand it? Like, how do you simplify it to them?
So I think it is important that as investment advisors, we be very, very clear as to what our objective function for a client is. And we are absolutely clear that our objective function is basically to increase the probability that the client will be able to meet the objectives for which the wealth is being generated or the wealth exists for him. And the manner of delivering that is through allocating the assets correctly. You have an allocation for equity, you have an allocation for debt, you have an allocation for gold, international equity, maybe real estate, depending on the size of the uh, investments. Uh, and all that allocation basically depends on what is the objectives of the client, when those objectives are due, what are the resources, existing resources, what are likely to be the future resources, what are his risk profile. So all this is actually centered around the client's needs, and it is our job basically to translate that into among other things, an investment basket. And so, therefore, explaining to him why he needs a basket and why that composition of that basket is much more important than the individual elements in that basket. I think that really is the major function that we perform. And the second major function that we perform is managing the expectation that the client has from how this basket will behave. And I think if we do the first part well, I think the second part is easier. So that's a rather long answer to how you sort of manage to explain such complex things as factor investing to clients very clearly. Today at least, the factor investment is happening only in equity, at least till today. So very clearly it is from that portion of the client's investments that are allocated for equity. Obviously it is among the higher part of his risk profile. Somewhere it will fit in between a passive and maybe an active mutual fund, somewhat below active PMS, or somewhat below an AIF or direct equity investment. So, that continuum is something that we do explain to clients. I don't think many clients understand factor investing. We are also not very old at this. We've been doing this for not more than the last 1 year or so. Uh, uh, I mean, the natural progression. We have progressed from passive, which we have been doing for quite some time, to factor based investing over the last 12 and 18 months. I won't say that our clients fully understand exactly what factor investing is. What they do understand is that it is placed in a risk profile that is somewhat to the right of an index fund and somewhat to the left of a active mutual fund.
Fair enough. Vaibhav, do you include factor funds in your portfolio in the PMS? If so, how much? Like, what is the allocation you give them?
See, Harsh explained this very nicely that all these strategies are ammunitions that we have. And we use these ammunitions with the sole objective of making sure that investors are able to get the desired results, which would include things like various asset classes within equity. Then you have factor funds, passive funds, and you have actively managed funds. I'm cutting across the vehicle through which these categories are managed. But all of these ammunitions are there with the sole purpose to achieve investors' objective. We do include these factor indices. So when we look at actively managed funds, we have seen the core philosophy behind actively managed funds is that fund manager will take bottom-up approach of investing. They will look at individual stocks and run their fundamental analysis, and basis that they will select some of these stocks. Now, sometimes individual biases do creep in the process of security selection. When it comes to rule-based investing, you are playing a particular theme, and boundaries are pretty well defined. There is no breach of boundary which will happen in any situation. What we do, we have an overlay of our own rule-based investing where we apply market cycles to understand which segment of the market, including which factor, is going to work in a given market environment. But at the end of the day, our objective is to make sure that investors stay invested for a long period of time to make sure that probability of them achieving their desired objectives are achieved. We have allocation to a couple of factor funds right now in our portfolio that we manage, but there could be a situation where we may not have any of these factor funds.
So if you are able to reveal which, according to you, which factor is currently going to work?
It's a tough one, but it's a dynamic process. Right now, we are invested in momentum index, but as I was listening to Deepak in the previous panel, and he said that today may not be the greatest time to invest in a momentum strategy. Unfortunate reality is most of the themes, most of the funds get popular at the peak of their performance cycle, and we are seeing incremental flows to these strategies. And our investment strategy is slightly contrarian, and we have seen that something which becomes extremely popular tend to underperform.
Fair enough. Sankar, to what extent do you incorporate factor investing in your investing style?
So I think a large portion of our equity allocation is factor based. At least this is the book that I am trading or I am investing in. We do predominantly factor based investing on the cash side. Yeah, I think it's a depending on the kind of it's factor investing is like a sweet spot in terms of it is not so fast moving that you need to keep changing your portfolios daily, monthly. At the same time, it's reasonably dynamic that you may perhaps not be owning the same set of stocks for years on end. So it's a reasonably good sweet spot between a very fast churning trading strategy, which may trade companies with a daily investment horizon, and a strategy which owns the same companies for a 3 to 5 year time frame. Factor investing falls somewhere in between. So for typical low to medium frequency trading styles, factor investing is a reasonably good approach, and that's kind of a major portion of the strategies which we allocate to and invest in fall in that spectrum. So we use factors reasonably heavily.
And you do it more through futures and options rather than the cash segment?
Do both. Actually, very few in options. Mostly cash as well as futures. Futures, the advantage is that they are more capital efficient. So you don't need to, deploy X amount of capital to get X rupees notional exposure. You just need to deploy a fraction of that. Of course, it comes with its own set of risks that any leverage strategy would come with. Cash is 1:1, so for 1 rupee exposure, you need to put in 1 rupee cash. Options, we don't do much of single name options because single name options tend to be very, very less liquid. And mostly, at least the options trading that has become popular in India is vol selling. And while vol selling can on textbook be attractive or on paper be attractive in single names, they are extremely liquid to kind of monetize in reasonably make money at larger capital allocation. So a retail investor may be able to do it, but if you're running a book of any meaningful size, that becomes difficult. Futures are a good middle ground, but again, there are only 200 names in the F&O space in India, roughly, give or take. And that kind of erodes into some of the efficacy of factor-based investing. So in the previous talk, I think you had a question as to whether factors work in the smaller names. And, what at least my anecdotal observation and experiences told me is that they tend to work even better in those names. Of course, given that you're able to find the liquidity. Now, if you are cutting off that universe completely from your trading and you're only focusing on the large segment, which are arguably more efficiently priced, the amount of outperformance that you may be able to generate become that much lower. So we use futures to express our factor views, but mostly from a shorting perspective. So let's say we want to short low momentum companies. Now that's not possible in cash, right? So of course SLBM is there, but very liquid again. So you short through futures, but for expressing any kind of long view, we mostly use cash.
I see. Now, if I were to play devil's advocate, Harsh, even if you think of a simple index fund, there's an inbuilt momentum strategy in indexing itself, right? The fund gets kind of cleaned up every 6 months. The bad performers get weeded out. Do we really need to complicate life further with a dedicated momentum strategy or ETF?
I think from our perspective, the way that we would look at it, is that why would we pick up, let's say, a momentum fund, and we do have some exposures to momentum funds, as we have to say a low volatility fund. A mix of the two is normally what we look at wherever we have looked at. The reason we picked it up is, I think the numbers are very, very persuasive, right? I mean, whatever your index construction is, you mentioned about index construction itself providing a proxy momentum. I'll come to that in a minute. But if you look at the numbers themselves, whether over a sufficiently long period, I mean, 5 years or 7 years, if you look at it, say 7 years rolling returns, data is pretty slim, of course, as Deepak already mentioned in the earlier panel. But assuming that that data is correct, ultimately it's just backtested data. But assuming that that data is correct, then on a 7-year rolling basis, I mean, 100% of the time, momentum would have beaten Nifty 50, which what most people consider market today. A very large percentage, I think 96 or odd percentage of the time, low volatility would have beaten the market in a 7-year rolling basis by substantial margins. So, I mean, that itself will tell you that whatever is the proxy for momentum in the Nifty 50 construction is obviously not working to the extent that, say, you mentioned. In fact, the discussion we are having internally is that given this kind of a outscoring, should you look at passives, I mean, broad-based index funds at all, or even active funds at all? Because if you can get, say, 5 or 6, and any allocation to equity, any kind of equity, for us will not come unless the money is there for 8 to 10 years. We take great care to manage the client's expectation, not to look at those returns in an intervening period. So we don't have this issue of matching our factors to market cycles, because this is an expectation that we do irrespective of what particular type of equity investment we are choosing. So that is an expectation management that we have well in place. Then should we even look at active or passive? That's a broad-based index. Now, that is the kind of discussion that we are actually having. So for me, this, as far as I'm concerned, it is ultimately remains to be seen what happens to liquidity, which is the big concern when the market sees a big drop. And we haven't seen a big drop since the time, factor investing has become popular. So that liquidity, whether this will play out, backtesting is all fine. There is things about the data that, Deepak also mentioned, and very clearly how reliable that past data is, plus how voluminous it is. It's only, say, 2 or 3 cycles at the maximum. So, given all that, I think a partial exposure to factor-based investing uh, for appropriate parts of a client's investment that is earmarked for equity is something we would stick to. We may start increasing the proportion, but it will never become zero. It will never become 100%.
Sure. One other thing that was also discussed in the last panel is that many of the active funds themselves employ factors, albeit actively. So there are value funds, there are versions of momentum funds. Growth is a widely used strategy. So, Weber, when you're deciding to allocate X amount to a dedicated passive uh, factor fund, is it that you're making a choice that no, the active guys are not able to implement this properly, so it's just better to go passive, or or do you see that this is just absent in the basket of active funds that you've chosen, therefore you want to have this in a passive way? Like, what is the thought process?
No, combination of both. So I mentioned earlier that most of the active fund managers are a big believer in bottom-up stock picking. So most of their alpha generation happens through security selection, and which will mean that they are playing with multiple factors at the same time. And sometimes when you want to go overweight on one particular factor, that's when you would introduce one of these factor funds. For example, most of the active funds will always be conscious of quality of the underlying portfolio and liquidity of the underlying portfolio. Sometimes when you want to add little bit of alpha to the portfolio, given that market environment is supportive of that strategy, you would want to add that incremental allocation to that particular factor. But honestly speaking, it's never a binary portfolio. We want to have both top-down as well as bottom-up investing approach. And combination of both of these strategies is what is best suited for the clients. What we are also optimizing is to make sure that clients stay invested for a long period of time. The only way to enhance clients' probability of making money is to make sure that they are able to stay invested for a long period of time. How do you do that? So there are two ways. A, you reduce the absolute volatility of the portfolio. And second, you reduce the volatility of alpha also. You don't want a situation where in 1 year your portfolio is underperforming by 10% and the next year it is outperforming by the 15%. So both of these variables are considered before we decide to allocate money to passive factor-based indices.
Yeah, no, I was just thinking one challenge that I also face as a journalist writing about these things is it's very hard to tell the story of passive funds compared to an active fund which is following that same factor. So if I had to tell, let's say, Axis AMC implementing quality,
Yeah.
that's easy to narrate. There's a fund manager there, he gives interviews, he explains
Yeah.
it with analogies. Here it's numbers and there's a screen. So when you have those conversations, how do you go about it?
So we look at Jim Simmons' data and show it to the clients that rule-based investing also has its place. And in fact, evidence is there, though in India, the evidence is not of that long period. But there is this interesting study which is done by Dimsons, Marsh, and Stonot. They analyzed factor-based investing going back 70, 80, 100 years. And there is a strong evidence that factor-based investing has generated significant alpha for the investors. But it comes with a caveat that anytime you are doing backtesting of the data, you're disregarding the execution constraints. Execution constraints are significant. In Indian markets, right now liquidity is ample because participation is high. But when market activity is low, liquidity in all these segments of the markets will also go down, and disproportionately larger drop in the liquidity will be there in these segments of the market. So we have to take back testing also with some degree of skepticism and apply it to whatever extent you feel is acceptable in the portfolio. It's not that difficult to explain because all of these rules are pretty well defined. You can create a reasonable amount of explanation around these. Momentum is nothing but an extension of what popularly is used as technical investing, where you're looking at the price volume action and extending that to say that this particular stock is in momentum and therefore you would invest in that. Value is pretty well discovered. Growth is pretty well discovered. So it's nothing but extension of the rules which are followed by the active fund managers. Whether active fund managers can follow these rules dispassionately and without any constraint is the only thing that we are considering here.
So Neil, we have a very easy answer to this. We tell when we are doing our client expectation management, we ask them, do you want a sexy strategy that may not make you money, or do you want a boring strategy that may make you money? I think when you put it that way, the answer is much easier for the clients.
No, I think on the Nifty point, the Neil, I wanted to add one point which Harsh explained very well. See, the issue with Nifty is it's free float based uh, index. So larger companies, regardless of their performance, will continue to enjoy decent allocation in the passively managed index. So that is something that we need to understand. That's a bit of a difference between other factor-based indices and your broad-based indices.
Sankar, one thing that you mentioned earlier is that you would use options or you would use futures if you wanted to take leverage or short. If you added these components, how much difference does it make? As in, without those things, is there a big difference in the returns?
So that's a great question. It's so with leverage, I guess your returns scale linearly, but your risk scales non-linearly. So the more leverage you take, for every 1 unit of additional return that you get on account of leverage, you are not adding 1 unit of risk. You are adding more units of risk. So that's well understood, I guess. That's, I think, generally the aversion to leverage that people typically have, etc. What I feel is the biggest strong point of using derivatives is not so much the leverageability as much as it is the ability to trade multiple strategies, which may be reasonably uncorrelated with each other, with the same amount of capital. So let's say I wanted to trade a long-short momentum strategy, and I also wanted to trade a long-only quality strategy. And let's say I want to trade trends across multiple commodities. And let's say I want to trade volatility using options. Okay. But I only have the same X amount of capital. Now, if I took leverage and double down on my investing in any one of these 4 strategies, that would not be great. Because, like I said, your volatility or your risk is compounding non-linearly or increasing non-linearly, while your returns are only increasing linearly. But when I'm combining these strategies, what I'm doing is I'm adding on to the returns, but I'm actually kind of moderating the risk of my overall portfolio because these strategies amongst themselves are reasonably uncorrelated. So that is the way I would look at. I'm sorry if it's getting a bit technical, but the point is, if 2 things, give you similar returns, but they behave differently completely to each other, not completely, but they kind of move in different directions. One works in a choppy market, the other works in a trending market, and you combine the 2. You are expected to kind of realize the general returns, the average return that each of those would give you. But you're expected to also kind of do or deliver that return at a much lower volatility. So it, in general, braces you for, staying invested. I think the biggest point that all of us are trying to make is, all these strategies, irrespective of how you express them, will only make sense if you are staying invested for a period of time. Now, with long only strategies or any single factor strategy or even multi-factor strategies, that's not very easy because, there is still volatility at the end of the day. And with the added, hurdle that you have to cross, like you said, it's easy to explain that XYZ fund manager, who's very well renowned and respected in the market, picked a particular company because, of course, an investor agrees that that person has done so in their wisdom, and their wisdom is more than ours. Now, the moment you stop relying on a fund manager's expertise and you rely only on computers and screens and whatnot and numbers, there will come a time when there will be a company which you are not comfortable owning as an investor. But as a strategy, you should own it. Now, if you apply your discretion, you're spoiling that strategy. Now, beyond the point, people don't concern themselves so much with the nitty-gritty, they concern themselves only with the outcomes. So if you present your portfolio in such a manner that the outcomes are more, less volatile and kind of something that you can stick with for a longer period of time, then you're still comfortable owning those names because you know that irrespective of all of these, you're realizing a certain return. So that's essentially how I would use leverage in derivatives in my overall trading strategy, and not so much as a means to increase my exposure with a limited amount of capital.
Yeah, essentially using the same money more efficiently, the same capital more efficiently.
That's right.
Now, a related question here from Madhur is, if you have momentum, low vol, quality, will there be a lot of overlap and how is it taken care of? So essentially you're saying there won't be a lot of overlap, right? These are not correlated.
They're not perfectly correlated, or they are not perfectly uncorrelated either. So the correlation isn't -1, it is in +1. So there's bound to be some overlap. Momentum, so let me take momentum a bit later, but traditionally, low volatility seems to have reasonable high correlation with quality, which kind of makes sense, right? Because a company which hasn't moved so much is also not moving so much because it's not impacted by surprises in earnings, either on the upside or on the downside. And that's the hallmark of a quality company. So we expect that overlap to be there. If you see the correlation between quality and value, there seems to be a reasonably negative correlation, which means there is very less overlap between the two. Which also makes sense because a high quality company, everyone knows what a high quality company is. Almost everyone is already invested in those companies, and hence it's reasonably fairly valued or most likely overvalued. So that's the opposite of what you would find in a value portfolio. So that actually bears out in the data that the correlation is negative. Now, a momentum portfolio is under the hood actually picking regimes, right? Because there may be a time when quality works. And if you suddenly look at the momentum portfolio, you'll see a lot of quality names there. And there'll be a time when value works, and you suddenly look at that portfolio and you see a lot of value names there. So the correlation over a longish period of time for momentum with quality or momentum with value may be zero, maybe even slightly negative. But it's very time invariant. So time variant, I'm sorry. So from time to time, the correlation may actually go up significantly or go down significantly. That's so you can't make a sweeping statement that there will be no overlap. You should expect lower overlap between value and quality, most likely. And if you see very high overlap, that's the perfect time to get into quality because quality names are available to you at a very cheap price, is what it means. So that's a fantastic time to get into quality. But assuming that sanity prevails and that kind of excess seldom exists, if ever, you should see less overlap between those two factors. And momentum from time to time you can. So for instance, for now, there'll be a lot of PSU names in momentum. These PSU names will also be present in a value factor. The reason for that is that PSUs have been on a tear the last year and a half, and hence they are present in both. But they are still undervalued compared to their private peers and so on. So so I would say momentum. I wouldn't concern myself so much with overlap in momentum. That's the nature of the strategy, of the factor, that it will time whatever is working. But the other factors, I think, should behave on these expected rates generally.
I'll take one last question from Vidyasagar, where he says 50% broad-based indices and 50% factor indices. Would this be a good portfolio? Harsh, Weber, anyone wants to take this up?
There is no model portfolio. I mean, what is it aimed at? Okay. I mean, again, you have to be clear what the objective function of making that investment basket is. What is the client expecting? What is part of asset allocation? What is the client's risk profile? So to say that 50 this and 50 that, I don't know. I think that's the wrong with, this is, give me an answer. No, I don't know what my problem is, but give me an answer, kind of a question. So I would say that there is no such thing as a perfect portfolio. It depends on the person, because if there was, why would anybody do anything else? So it really depends on the needs of the particular investor.
Fair enough. Weber, any rule of thumb? I know that, as Harsh said, we can't generalize. It's each investor is different, etc. But is there any rule of thumb you can give?
So I think it's a very difficult one, and I always use this doctor's analogy that you don't expect the doctor to give the same medicines to all the patients. You'll have to evaluate their situation, their symptoms independently, and basis that you need to prescribe the medicine. In our business also, I think we have to apply the same principle. We can't give the same model portfolios to all the clients. For us, there is one more added layer to that. We don't have any model portfolio concept. Our portfolios will keep changing depending on when the client is giving money to us, and also the kind of investment environment which is there. One thing which I learned very early in my career is clients' return expectations change. Their risk tolerance never change. So if markets are bullish, everyone would want to maximize their returns, but their ability to manage risk never changes. Most of the investors who are bullish, given the way environment is, will start panicking if they see a 10% drop in the market. A lot of people reach out to us for our inputs when markets correct by 3 or 4%. And for someone who spent 20 years in the market and has witnessed 60-70% drop in the market, I find it difficult to respond to those kind of questions that 3 and 4% correction in the market doesn't count for anything. So I think to summarize, honestly, my view would be there is no standard portfolio for all the investors. All the investors would need their individual customized portfolios. The essence of the portfolio should lie in how well you are able to manage both risk as well as returns.
All right, fair enough. So we're almost out of time. Let me take some closing thoughts, starting with Sankar.
So yeah, I think few of us have been in this space for a while now, and we've all been hoping for a day like today where we actively engage in discussions talking about the growth of factor investing. And I'm really glad that that discussion is happening and people actually are interested in understanding what works under the hood. I still remember the times when these strategies would be lambasted by even knowledgeable participants in the market, because there was, so for momentum, for example, that there was in fact Warren Buffett once quipped that there couldn't be a worse reason to buy a stock other than the fact that its price has gone up. So there were all these kind of statements which were getting passed and which were getting, of course, that was said in some context which perhaps was misconstrued, but from those early days to where we are now, where we are actively engaging and we have a factor conclave by AMCs. So I'm really hopeful for the growth of factor investing as a concept. I personally have allocated significantly to different factors in my personal portfolio. Like I told you in the book that I trade, factors are the big part. Part of me is also kind of sad that the kind of returns one could perhaps have made earlier will not be as easy to make in future if there are enough people trading these strategies, because they then become very popular. But I guess that's the trade-off, right? With better knowledge, better awareness, better participation, also comes the risk that the outperformance that these strategies were able to run kind of go off to some extent. So the only cautioning statement I would like to make as my concluding thought is, go by data for sure, but also take it with some, with at least a slight dose of salt, if not a heavy one, because what you saw in the working out in the past may not necessarily work out in the future, and these factors have long cycles. So value had a 10-year, 15-year underperforming period in India, globally. Quality currently is going through kind of a lull. Momentum will surely have a time when it doesn't work. So don't be in these type of strategies if you are looking to make a quick buck. These are not those strategies. These are strategies for the medium to long run kind of cycle. And if that's really what it is, I think it's a great phenomenal addition that one can have in there.
Absolutely. Well said. Harsh?
Two thoughts. I mean, I would second what Shankar just said. There is no magic panacea. I think if any investor is looking for a magic bullet, factor investing is not that, index investing is not that, active investment is not that, PMS is not that. The magic bullet does not exist. And I think that message should be clear. My second point that I would like to make is that I think there is a need, and I know that factor investing itself is roughly about an 18,000 crore industry, but fast growing, most of it through mutual funds, from what I understand. But a PMS, because the biggest issue or the biggest apprehensions around factor investing is the liquidity of the underlying stocks in a bad market. And I think PMS resolves that issue, where I don't pay, where the investor, specific investor, does not pay the cost for the stampede of the people who are not well prepared, because they can continue to hold on to their stocks and live through the stampede. So I think a low-cost PMS, factor-based PMS, is something that people here and maybe people outside should definitely look at. I think it is time. I think it is time that that should be considered.
Interesting. Vaibhav, concluding thoughts, and is that something you would go with, the PMS? You already have one, but perhaps one that is also focused mainly on factor investing.
No, absolutely. And we are in the midst of creating a product around that. My only submission is that factor investing is nothing but rule-based investing. And rule-based investing should also be done after applying certain rules. Both Shankar and Harsh explained that there are cycles where some of these factor indices may not perform, and there are long periods of underperformance. Investors have to be mindful that they are selecting indices with negative correlation, or at least negative alpha correlation, where their sources of alpha are different in each of these funds, so which doesn't lead to any kind of disappointment for them. And B, it's not the single instrument which is there in their portfolio. And third, as a last thought, is don't chase performance, because performance, something which has done well in the past, may not continue to perform. We've seen that happening with multiple fund managers, multiple schemes, where investors keep shifting lanes and end up generating returns which are lower than what the markets would have offered. There's an interesting study which I can't recollect the fund's name, but they had carried out where they measured the performance of the fund and performance of the investors in that fund. The gap between funds performance and the investors performance is 10% year on year, which is
I remember this, right? On Access AMC one.
yeah, which is called behavioral gap. And we have to be mindful that you're not chasing the winners with the belief that they will continue to deliver.
Absolutely, well said. If one changes lanes too often, it just increases the chance of getting into an accident.
Absolutely.
All right. Thank you all so much. And thank you to our audience as well for listening to us so patiently. hopefully we've been able to shed some light on this quite complex subject. Thank you.
Thank you. Thank you.
Thanks, guys. I'm logging off.
Great. Thanks. Thanks for all the panelists for a very insightful discussion. Thanks everyone for joining us for this Factor Conclave. This is the second one we're having, and we obviously want to have a lot more. Also, very encouraged by the sort of response we've got. Almost maybe just over 4,000 viewers today, which is a lot more than what we had the last time. And we'll hopefully continue on this tradition of educating our investors on all the latest stuff that is happening in the industry. So before we log out, just wanted to quickly summarize. Today, we had a great session. Thanks to all the entire MOMC team, marketing team, as well as the tech team for doing this. And obviously, you can expect a lot more events from us. But to start off with, we talked about what factors are and why they can be a very compelling opportunity for investors to place in their portfolios. We in the first panel we talked about a global lens of factors, how factors have become extremely popular globally, and what sort of resources you could have to really explore the space. We also talked about the concept of why factor investing works and why people are excited about it. In the second panel, we talked about how I think factor investing can be used by retail investors. So we had some very prominent, some of I think some of India's leading wealth managers and asset allocators, and also someone coming in from using factors from derivatives and other options. So I think that was a great discussion on how factors could be used for asset allocation. And also, we have a lot of questions also. So please, to the audience that came in today, please do reach out to us for any questions. Our panelists should be able to answer them on different social media platforms, and me and also my team will also be able to answer all your questions. One thing I think some viewers did complain about blurry presentation. This entire conference will be uploaded on YouTube, so I think on there there is a lot of clarity. And for anyone who's looking for the presentation that I presented, please do reach out to our team and we'll send it over to you. With that, thank you so much for coming in for this conclave, and we look forward to more participation from all of you in the next one. Thank you, everyone, and good evening.